Hello, everybody. Welcome to this quarter's Market Outlook and Strategy webinar. My name is Jeff Porter. I'm Chief Investment Officer here at SBSB. And as always, I'm joined by Gary Lyons, Senior Director of Portfolio Management.
Hello, everyone.
And Ken Alozie, Director in the Portfolio Management Department.
Hello, everyone.
So we wanted to start off today by taking a look at these first quarter asset class returns for the major indexes. Because while you see that they're not large numbers in either direction, there's a lot of red arrows there. Starting over there to the left, U.S. short-term bonds were down 0.2%. The U.S. aggregate bond index, so these are taxable bonds, intermediate term in nature, down 1.5%. Tax-free munis, down 1.1%. As we look over to the stocks, U.S. large company stocks, represented there by the S&P 500, down 0.8%. Small cap stocks down a touch. International developed stocks, so this is Europe, Japan, and the like, down 1.8%. And the only green arrow up there, as you can see, is the emerging market stocks up 1.4%. So it's important to know that this is fairly rare, that both stocks and bonds are down at the same time in a quarter. In fact, it's been about 10 years since that last happened. And if you look at all the quarters over the past 30 years, it's only happened about 8% of the time. The good thing for investors is that when you look at calendar years over the past 30 years, there's never been an instance where they're both negative. And that's why, obviously, stocks and bonds go so well together in a diversified portfolio. But, talking about this quarter, the negative volatility here really didn't start with the tariff news, as many people think. It started with heightened inflation expectations and interest rates moving up, with the 10-year Treasury yield getting close to 3%, and that hurt bonds and, in turn, spooked the stock market as well. So that's why we wanted to focus this presentation just on inflation and interest rates. So as always, we're going to start off with a little education. We're going to talk about why bonds and stocks, at times, not always, but at times can fear inflation and rising rates. Then we'll talk about the current market environment, our expectations for the future, and we'll wrap up discussing what it all means for your investments. So let's start by looking at this relationship here, the relationship between inflation and interest rates. So what you see in blue there, that's the Consumer Price Index, the CPI. So this is a basket of goods and services that's supposed to estimate the cost of living. The red line there is the one-year Treasury yield. And you can see those are fairly tightly correlated, tight relationship both on the way up as well as the way down. So why is that? Well, what central banks and the Federal Reserve fear most is deflation. So deflation is when prices continually go down. So if you're a consumer and you're thinking about buying a house or a car or a TV set, and you believe the prices of those items are going to be lower in 3 or 6 months or a year from now, then you're going to hold off purchasing. And if you get millions of people thinking that same way, that really drives the economy down. So that's why the central banks and the Federal Reserve fear that. So the way that they combat that is by lowering rates, essentially making cheap financing available, trying to incentivize not only consumers, but also corporations to spend. So the Fed likes a little bit of inflation, but they don't like too much inflation. Too much inflation reduces all of our purchasing power. A dollar can't buy as much. That certainly impacts our way of life. So when the threat of inflation rises, what the Federal Reserve does is raise interest rates, tries to slow down the economy, slow down all the purchases that are going on, and hopefully that keeps prices at a comfortable level. So that there is the relationship between inflation, interest rates, and the economy. But Ken, I'm assuming a lot of our listeners are most concerned with how this all impacts their investments, similar to this guy here that's worried about his bonds. So why don't we start by talking about how this impacts bonds as an investment?
Sure, Jeff. It's really interesting. For the first time in a while, investors are seeing negative bond returns. Now, We saw this during the taper tantrum in 2013 and briefly in November 2016, right after the elections here in the US. And investors just aren't generally used to seeing this. We've had a 36-year bond bull market where interest rates have trended downward pretty much the whole time. And since the 80s, inflation's pretty much stayed in that 2 to 4% range. And we've even seen it struggle to stay above 2% post the Great Recession. And so today, we have a Fed that's at the beginning of what seems to be a rising rate cycle. We're coming off of extremely accommodative monetary policy. We're at full employment here in the US. And we've now injected fiscal stimulus into an economy that appears to already be pretty late cycle. And so there's now concern over rising rates and rising inflation, both of which could impact bond returns. And so during our last webinar, you may remember that I talked about how stocks are valued, and today I'm going to talk about the relationship between interest rates or bond yield and bond prices. So many things can cause yields to rise, and one of those is the Fed. And when a central bank like the Federal Reserve raises interest rates, this causes the required rate that investors demand on their bonds to go up, and hence yields rise. Now, the result is that the value of existing bonds that pay a fixed interest rate will go down. And so I'll illustrate that with an example. Let's say the going rate on a given bond is 2%, and then yields rise to 3%. Now, those bonds that are still paying 2%, they're now less attractive than before, and so the market will price those bonds lower. Now, because of the threat of rising rates and inflation, investors aren't just worried about bonds, they're worried about stocks too. Now, higher interest rates increases the cost of borrowing for companies, but it also, from an investor standpoint, decreases the relative attractiveness of stocks versus cash or money market funds. In other words, as rates go up, cash and money market funds start to be a little bit more of a viable investment alternative. Higher inflation can also be a problem for stocks. As Jeff said earlier, inflation erodes consumer purchasing power, but inflation also reduces the value of a company's future earnings, which is essentially what you buy when you buy the stock of a company. Now, over a longer period of time, stocks actually tend to hold up pretty well when you see steadily rising inflation that remains manageable. And the reason is because companies can simply pass rising costs on to consumers. The problem comes when you see inflation spikes or runaway inflation. That tends to be bad for equity markets, and that's partly because significant price increases do impact the demand for goods and services and can ultimately reduce company earnings, which of course is how stocks are primarily valued. So we'll illustrate that last point with an example here. So this chart shows that as inflation goes up, the amount that investors are willing to pay for stocks, which we'll refer to as the valuation, goes down. And of course, higher inflation can cause higher interest rates. Now, inflation, as measured by CPI, or the Consumer Price Index, is running along the bottom of each bar here. Now, the numbers at the top represent the valuation of the stock market, which is really the average rolling 12-month price-earnings ratio going back to 1950. But the higher the valuation, the more expensive the market. And as you can see, there's generally an inverse relationship between the inflation rate and stock valuation. So in other words, as inflation gets higher, investors ultimately are willing to pay less for stocks. And the exception is the first bar here, which shows a range for inflation between -2 and 0. Now, the reason that this bar isn't higher than the one after it is because a deflationary environment is typically indicative of a recessionary environment that Jeff alluded to earlier, where you see slowing or even negative growth. And so, to wrap up, we've talked about the historical impact of interest rates and inflation on both the stock and bond markets. Gary, can you talk about the current environment and what we're actually seeing today?
Certainly can. So as we've discussed in the last few webinars, the U.S. economy appears to be in the latter innings of its economic cycle. And typically at this advanced stage of the cycle, inflation pressures tend to rise as commodities and wage prices increase. Now, we see a number of leading inflation indicators signaling that over the near term, inflation is headed higher, including but not limited to what you see here on the chart. On the chart, the red line there is the New York Federal Reserve's underlying inflation gauge, which is constructed using a combination of wage, labor, and interest rate spread related variables. On the right, you can see it has now risen to its highest level in over 12 years at 3%. Now, the New York Federal Reserve's underlying inflation gauge leads the core consumer price index, that's there in black, the black line, by about 16 months, and it has a correlation of over 80%. Now, that New York Federal Reserve underlying inflation gauge is more volatile, actually, than the core consumer price index, or the CPI, again there in black, the black line. But even so, you can see that the New York Federal Reserve's underlying inflation gauge is at 3%, again the red line. And while that does not mean that the CPI is necessarily going to 3%, we have seen such a strong rise in that underlying metric over the last 6 months that it's signaling that inflation is headed higher, at least shorter term.
And Gary, as I was showing earlier, when you're talking about inflation, you're talking about interest rates. And when you're talking about interest rates, you're talking about the Federal Reserve. So what can we say about the Fed?
Absolutely, Jeff. So here in green is the Federal Reserve's current guidance for future interest rates. And in blue there, you see the current interest rates of the market pricing of that Federal Reserve's guidance. Notice the markets are pricing in much lower rates than the Federal Reserve's rate projections, especially through 2021. Very divergent. And the actual interest rate market thinks the Federal Reserve will not raise rates that much or that fast. In other words, the market doesn't believe the Fed will follow through on its plan for rate normalization after hiking this year. And I think the markets have been so used to discounting the Fed's guidance, Jeff, for actually so long that markets could easily be surprised by faster rate increases.
And it's this risk, in inflation and this risk in interest rates that is essentially making the market very sensitive to news about tariffs and a potential trade war, which has certainly been a hot topic nowadays. So why don't we talk about that, Gary?
Absolutely, Jeff. So the tariffs and the threat of these trade wars are obviously not helping market volatility, and we've seen lots of volatility this year. Again, volatility are just those sickening ups and downs in the market's pricing, and volatility is definitely increasing, as you see here on this chart. Now, this is what has happened so far, and its impact on the S&P 500's price return, which is actually there on the blue line. So starting on the left, on March the 1st, President Trump announced tariffs on steel and aluminum, and we were down about 2.4% at the lowest point. On March the 8th, Trump exempted Canada and Mexico from those tariffs, and we were up about 1.6% at the highest point. March the 22nd, Trump signed $60 billion of tariffs on Chinese imports, and we were down in total 5.6%. As you can see there, we recovered a bit, but on April the 2nd, China announced their own $3 billion of tariffs on U.S. goods, and we were down 1.45%. April 4th, China announced more tariffs, this time another 50 billion of them on U.S. goods, and we were down approximately 2%. And then on April the 10th, China pledged to open its markets for foreign companies, and we were up approximately 4%. So, we can see that all these dueling tariff announcements have caused lots of stock market volatility. And, Jeff, we saw the same effect as the market perceived escalation and de-escalation in Syria, for example. So markets have responded very unfavorably to the possibility of trade wars, and we just wanted to go over with you the reasons why they have. Number one there, obviously protectionist measures and the resulting retaliations have the potential to really slow down global trade as well as economic growth. Point two there, unilateral trade deals make it very difficult for American companies to compete against other countries participating in the multilateral trade partnerships. And, that's pretty self-explanatory. Obviously, if they're cooperating with each other on taxes, port access, and faster import approvals, that's going to make trade a lot easier. And then finally, if you think about it, global supply chains are extremely integrated. And so all the costs of these tariffs are actually passed on to consumers. And that results in inflation, first in producer price inflation, and then in consumer price inflation. And, Jeff, global trade had been on a very good track. We had seen the most rapid growth in 6 years, according to the World Trade Organization's annual analysis back in March. But now these tit-for-tat tariff wars and import taxes, I think they can lead to unmanageable escalation. And actually, the World Trade Organization's annual trade report said the risks are now tilted to the downside because of uncertainty over these policies. Also, this can, as we've seen in the past, bring lots of volatility to markets.
And your third point there, really brings it back to what we're focusing in on today. Essentially, this risk of inflation is adding fuel to a fire that's already there. Now, the fire isn't out of control by any means, but it is there, and that can be seen in this next slide.
It certainly can, Jeff. So here in red is the U.S. Bureau of Labor Statistics Import Price Index. So this is all imports excluding things like fuels, like petroleum. And as you can see there with the red arrow on the right, U.S. inflation is definitely warming up. We're paying more for almost everything as inflation continues to creep higher. And both the World Bank and the World Trade Organization are saying we should expect import prices to edge gradually higher all year, all through 2018. And, Jeff, that keeps pressure on the Federal Reserve's Open Market Committee, which is the group that's responsible for monetary policy strategy and implementation. It keeps pressure on them to normalize rates through interest rate increases.
That's right. So to summarize this section, we definitely are seeing some pressures here for inflation, pressures on interest rates. Now, this is somewhat normal, or this is very normal, I would say, in the late innings of a business cycle, and that's why it's called cyclical inflation. But now let's turn our attention to the bigger environment, the longer-term environment, because we see, what we would call secular or structural forces at play. These are the big elephants in the room that should keep inflation and interest rates fairly low. So have a look at these three charts down here, and let's start with the left. The left is just real GDP growth, so economic growth. And you can see we really peaked out in the 60s here, and ever since we've been trending down. With each business cycle, it seems like the peak growth gets lower and lower and lower. And often when this happens, the most likely result is inflation going lower and lower and lower, as you can see there in the middle chart, which brings us right back to what I was talking about earlier. If inflation is lower, that generally means that interest rates are lower. That can be seen on the chart to the right there, which is the 10-year Treasury yield. Again, nice little downtrend there. So the question is, why is this happening? And then could it continue to happen? And the answer is, yes, it's happening, and it could continue to happen. And one of the reasons why is debt. So as John Adams said, there are two ways to conquer and enslave a nation. One is by the sword, and the other is by debt. So the data you're looking at right here is from Carmen Reinhart and Ken Rogoff, two very well-known economists in our industry. And what they wanted to know is there any connection between the level of debt that an economy has and the growth rates, the economic growth rates? So they looked at hundreds and hundreds of advanced economies as well as emerging economies, and they found that there is something here. So let's take a look at that. Look at the below 30% column. So that is when the government debt to GDP ratio is below 30%, essentially low debt relative to an economy. And you can see there that the average economic growth is great, 3.7% average, 3.9% median for the developed advanced economies. And you look down to the emerging market economies, the average growth rate is 4.3 and 4.5%. So fantastic. Now, if you start scanning to the right there, the 30 to 60% column and then the 60 to 90% column, you can see the growth rates start to trail down a little bit, but not too bad. But have a look now in the red circles. When debt to GDP ratios are 90% or above, there's really a big drop-off in economic growth, 1.7 and 1.9% for the advanced economies, and then 1%, even for the fast-growing emerging economies, averaging 1% growth and 2.9 for the median. So why is this important? It's important because of this slide here and the chart to the right. Because the United States debt to GDP ratio right now is way over 90. We're at about 106 now, and the estimate is for it to rise. And the reason why it's going to rise is the chart to the left, which is our surplus or deficit. Surplus just means, are you taking in more money than you're spending? Deficit is we're spending more than we're taking in. And you can see our deficits have been growing larger and larger the past couple of years and are set to get worse. So, the reason why this is worrisome is that we are about 9 years removed from our last economic downturn, our last recession. Our economy should be humming right now. Tax receipts should be plowing in. We should be running a surplus like we did in the late 90s, or a smaller deficit like we were running in 04, 05 time period, not the large deficits that we're seeing now. So the risk is that in the coming year or 2 or 3, we run into another recession. And that dries up tax receipts. We usually increase our spending to get ourselves out of the recession, and that would drive up, make the deficits even worse, as well as our debt problem. So that's the risk, but one of the reasons why economic growth is likely to remain slow, thus inflation low and interest rates low as well. So, Ken, what are some of the other kind of major issues, the structural issues that could keep interest rates and inflation low as well?
Sure, Jeff. And now another factor that will likely keep both interest rates and inflation trending lower over the long term is U.S. demographics. So this chart here shows the percentage of the population age 65 or older for each of these 3 time periods. So if you look here, in 1950, the percentage of the population over 65 was 8%. After that, it took 60 years for that number to increase to 13%. And now, just 15 years after that, in 2025, this number is projected to increase up to 19%. And as this age group grows, what you have is a larger proportion of the population that's spending, not earning, drawing on entitlement spending or retirement assets. And we've seen this dynamic at work in countries like Japan. And now another factor that's likely to keep interest rates and inflation trending lower over the long term is automation. Now, automation is just the use of machines in the production of goods. So the chart here shows the worldwide growth in machines that are used in production since 2008. And as you can see, that this number has historically trended upward and is projected to continue to climb going forward. And what automation does is it generally lowers the cost of production, which then lowers the prices of goods. And we believe that this will continue to keep long-term inflation and interest rates fairly low. So these forces that we've discussed, rising U.S. deficits and debt that Jeff, you talked about, but also aging demographics and automation have already, in fact, made it challenging to generate inflation. And what we're looking at here in this chart is PCE over time. Now, PCE just stands for Personal Consumption Expenditures, which is the Federal Reserve's preferred measure of inflation. And this is going back to the mid-1990s. Now, the Federal Reserve likes to see a core PCE number of at least 2%. Looking at the chart here, though, you see that not only is PCE currently below that target, but this measure has been subdued for some time now. And Jeff, that is in part due to these factors that we've discussed.
Absolutely. So we are seeing some cyclical pressures, but secular forces, longer-term forces that should keep things contained. So with this view, Gary, now let's talk about the investing implications, and then we'll wrap up with some key points.
Absolutely, Jeff. So here on this chart, we see the implications for various asset classes. Now, in the short term, and looking at bonds, well, we could see the risk of slightly negative returns with corporate bonds being especially at risk due to their credit exposures and increased corporate debt service burdens, especially in this tightening part of the interest rate cycle. Here we recommend staying in high-quality bonds with slightly shorter durations. Now, the implication in terms of the intermediate term for bonds, obviously if rates continue to rise in the short to medium term, the income generated by intermediate term bonds will become increasingly attractive. And they also offer potential price appreciation should rates decrease as a result of a recession. So we recommend lengthening duration should rates continue to move up. Now, stocks we expect to continue to climb, but with likely way more volatility due to inflation coupled with rising rates. And that would be just your classic late cycle activity, as we've talked about in other webinars and at our symposium in January. So we recommend exposure to economically sensitive sectors, financials, energy, industrials, materials, and higher quality stocks should short-term inflation and rates continue higher. Now, our value overweights in our portfolios naturally place us there in these sectors at this part of the cycle. And then finally, for those clients wishing for enhanced diversification designed to offer more inflation protection than stocks or bonds, we recommend alternative strategies. But in regards to inflation, it could increase in the near term, but it will probably continue its trend of a longer-term decline for the reasons that Jeff and Ken have mentioned, the huge debt that's out there, the unfavorable demographics, and lots more automation that is bringing costs down.
Well, thank you, Gary. So we've been summarizing along the way here, but it's always good to review things once again. So we started off by showing you how stock and bond markets can be significantly impacted by inflation and interest rates. That's why we keep a close eye on both, and we try to get a sense of what things are going to look like in the future. We are currently seeing cyclical inflationary pressures build. This could certainly cause more and more volatility in both the bond and stock market. And as we discussed, a trade war certainly would not help. However, we are seeing strong structural forces in play: debt, demographics, automation, among a few others that we didn't mention today. And this should be a weight on both inflation and interest rates and contain them from getting too high. Now, Gary just went through some general investing implications there. We didn't want to flood this with another 10 or 15 slides. So stay tuned for our next webinar, where we're going to take a deeper dive into those investment implications and talk to you about how we're positioning portfolios.
Absolutely. So thank you all so very much for joining us today. We so very much appreciate our clients, and we're always happy to talk with you. Call me, call Jeff, call Ken, call your RM if you need to discuss anything, or if you want to comment, or if you just have a question. We always enjoy hearing from you.
Thank you.
Thank you.